If you've got money in the stock market and you are looking for how to protect your finances against market crashes, then you are watching the right video. In mid-March 2020, the Dow Jones Industrial Average closed below 20,000. As I write this, almost 2 years later, it's more than 34,000. That's a gain of 70%. The tech-heavy Nasdaq index has done even better. It's nearly doubled. But as they say, what goes up must come down. Maybe not today, not tomorrow, but trees don't grow in the sky. So, as a smart investor, what do? If you sell, you can be leaving money on the table. But if you don't sell, all those profits may one day seem like a pleasant dream to you. While there may be no perfect solution, there are some techniques you can do to protect your profits and prepare for the inevitable. Before we unveil some of those things, quickly take a moment to like this video and subscribe to stay updated on our videos. Now we're going to talk about some of the things you can do to keep yourself on the safe side. Step 1. Change your investments. To change your investments, you will need to check your current investment allocation. You may not know what your retirement fund is invested in. If you don't, now is the time to log into your account and check the current allocation of investments, including bonds, real estate, stocks or stocks mutual funds, and money market accounts. Know why you are scared of a market crash. When there is a market crash, stock becomes very cheap and you may not want to diversify your portfolio because of this. While you may want to leave your investments as they are, it's important to consider diversifying to ensure you are comfortable with your investment mix. Since you can't predict when the next recession will hit, don't move money in and out of the stock market, hoping to get out just before things turn south. For example, in 2015, it looked like the US stock market was about to crash, and it didn't. Since then, the Dow Jones Industrial Average has increased more than 20%. Hold money in a savings account. You can protect your investments by getting out of stocks and moving the money to savings accounts. This can be done using a money market account and a high-yield online savings account. As for the money market accounts, they are like bank accounts but with potentially higher returns. You can write checks against the money market account. Open with your bank or with a company like Scottrade or TD Ameritrade. Then the high-yield online savings accounts will only earn about 1 to 2% annually, but this amount is higher than most banks offer. Your cash is liquid, so you can access it if needed. Also, your deposit will be protected by the Federal Deposit Insurance Corporation, FDIC, up to $250,000. Invest in bonds. Companies and governments issue bonds to raise money. Since they are safer than stock, you should consider putting more of your investment into bonds. You can try out US savings bonds since they are very safe. With this, you will get a fixed interest rate, and your return is linked to inflation. You can also earn an automatic rate of return each month. Another option is municipal bonds. They are a low-risk investment unless the city government is on the verge of bankruptcy. Consider annuities. Compared to stocks, annuities are safer. However, they do have some risks. For example, the company you bought the annuity from could go bankrupt, and you won't get paid. Do thorough research and buy an annuity from a company with the highest rating to protect yourself. Invest in safer stocks. Some stocks are safer investments in a down economy than others. Look towards buying high-quality stocks which tend to hold up better. These companies have stable earnings and low debt. You can also consider stocks that pay dividends. Change your contributions. Consider changing the allocation of your retirement contributions for the last few years before you stop working, especially if you aren't retiring yet. Direct your contributions towards safer investments. Diversify your portfolio. When the market is good, riskier investments, such as stocks, perform well. But when the market crashes, you can expect stocks to perform poorly. Accordingly, you might want to diversify your portfolio and move some money out of stocks. If you don't know what to do, meet with a financial planner who can help you assess your risk tolerance and develop a plan suited to your needs. Step 2. Reduce your debt. To do this, know your debts. When there is a market crash, you will need money to pay for living expenses. Now is the time to decrease your debt load. You can do this by identifying your debt in your car loan, student loan, home mortgage, personal loans, and credit card. Prioritize your debts. Aim to make minimum monthly payments on all your debts. Sit down and prioritize your debts accordingly. If any debt is tied to an asset, paying them off earlier could be wise. Budget. A budget is needed to free up money to contribute to debt payments. Check your fixed expenses and discretionary spending and see where you can reduce them. Refinance your mortgage. Since mortgage rates are still low, consider refinancing into a loan with a lower one and avoid spending the money you save. Instead, funnel it toward debt repayment. Focus on the credit card debt. When the market crashes, you will want to have a stable balance sheet. Therefore, you need to reduce your debts as much as you can. In particular, you should pay down high-interest credit card debt. Step 3. Prepare for emergencies. For this step, you will need to build an emergency fund. Since you will need money if you lose your job, it's important to save down 6 months of expenses. Set money aside for your emergency fund every month. If you are a retiree, you should try to save 2 years of expenses. When the market declines, you should live off your savings instead of drawing income from your investments. Buy insurance. When you buy insurance, you will get protected from unforeseen accidents that will hammer you financially. Also, during an economic downturn, you will need all the money you can get, and insurance will provide valuable protection in case an accident strikes. For your insurance, you can consider automobile insurance. In this case, your insurance will pay if you injure someone in an accident. You might also be covered if someone without coverage injures you. Health insurance. You can buy it on the government exchanges if not offered by your employer. Life insurance. You can replace the income of a working spouse with a life insurance policy. Life insurance is particularly important if you have young children. Calculate how much life insurance you need at lifehappens.org. Disability insurance. This is helpful for people with disability. If you get disabled before retirement, you will need income to support you. And finally, the homeowner's insurance. The homeowner's policy should cover any injury that occurs on your property and structural damages caused by accidents and natural disasters. Consider the stability of your job. When there is a market crash, many jobs will get wiped out since employers will be forced to lay off workers. It's important to assess whether your job is stable enough to survive a recession or not. If you think your job won't be secured, then you can start picking up some freelance or part-time work now. That's buying yourself some income security in case there is a crash. And there you have it, the many ways you can protect your finances against a market crash. What have you learned so far? Let us know in the comment box below. See you in the next video.